What's the smartest way to start investing online if all you have is $100 and you don't want to gamble it away? As an investor, this is one of the most common questions I get. People want to grow their money, but they're overwhelmed by options, scared of making mistakes, and unsure where to even begin. 4 years ago, instead of guessing, I decided to test it myself. I took $100 and invested it into 5 completely different things, all investments you can make online, from your laptop with no special access or insider knowledge. Today, we're revisiting those exact investments to see how they actually performed over 4 years. Not in theory, not based on averages, but based on real money, real decisions, and real outcomes. The goal is simple: to figure out which investment makes the most sense for beginners starting small. To keep things fair, I'm judging each investment using the same criteria. First is the learning curve, how long it takes to understand what you're doing and invest confidently. Ideally, the shorter, the better. Next is passive income potential, which looks at how much money the investment can generate for you without selling it. Then there's tax efficiency, meaning whether there are legal ways to reduce how much tax you pay on your gains. After that comes risk level, how volatile the investment is and how likely you are to lose money. And finally, the results. This is where I'll show you my exact percentage return and what that original $100 is worth today. Before we dive in, a quick disclaimer. I'm not a financial advisor. I'm just sharing my personal experience and results from investments that have worked and sometimes not worked for me over the years. Let's start with individual stocks, one of the most exciting and risky ways to invest. When you buy a stock, you're buying a small piece of a company. If that company grows, becomes more profitable, and increases in value, your investment can grow with it. That's what makes stocks so appealing. You're not just watching numbers on a screen, you're investing in real businesses you believe in. That said, the learning curve here is high. Successful stock picking isn't a guessing game. If you want to do this properly, you need to understand how companies actually work. That means looking at financial statements, evaluating leadership teams, understanding competitive advantages, and paying attention to brand strength. When I invest in individual stocks, I look closely at income statements, balance sheets, and cash flow statements. And once I invest, I'm not thinking short term. I'm planning to hold those stocks for at least 2 to 10 years. This isn't day trading, it's long-term ownership. For beginners, one of the best ways to learn is through investing apps that offer demo accounts. These let you practice with fake money, so you can understand how the market works without risking real cash. When it comes to passive income, individual stocks can be very good. There are 2 ways you make money here. The first is price appreciation. If the stock price goes up, you can sell it for more than you paid. The second is dividends. Some companies pay regular dividends to shareholders, which means you can earn money without ever selling your stock. That's genuine passive income. Tax efficiency is also great if you use the right accounts. In the UK, stocks and shares ISAs allow you to invest tax-free. In the US, Roth IRAs offer similar benefits. These accounts act like a shield, protecting your gains from taxes. The rules vary by country, so it's important to research what applies to you. Now for the downside, risk. Individual stocks are high risk. I learned this firsthand during the dot-com boom in the 1990s. I picked a few great stocks, sold them at the right time, and made good money. But I also invested in companies that completely collapsed. Some went out of business entirely. Even though I made money overall, it showed me how dangerous it can be to put all your money into just a few companies. To test this properly, I invested my $100 completely at random. I threw a dart at a board with 20 stocks on it and invested wherever it landed, blindfolded. That dart landed on Samsung. 4 years later, that $100 investment is worth $67.66. Over that time, I earned 10 cents in dividends, bringing the total to $67.76. That's a negative return of 32.34%. And this perfectly shows how hit or miss individual stock investing can be. That dart could just as easily have landed on Apple, Microsoft, or Nvidia. If it had, the results would look very different. A $100 investment in Apple would now be worth $170. Microsoft would be $188, and Nvidia, $900. That's the reality of individual stocks. The upside can be massive, but only if you pick correctly. Luck alone isn't enough. You need strategy, research, and patience. Next up is real estate, but not the kind where you need a mortgage, a deposit, or a call from a broken boiler at 3 a.m. A REIT, or Real Estate Investment Trust, allows you to invest in property without actually owning it. Imagine 3,000 people each putting in $100. That money is pooled together to buy properties, rent them out, and share the rental income among investors. That's essentially how a REIT works. You might own the metaphorical front door, someone else owns a window, and together you all own the entire building. The learning curve here is moderate. REITs are much simpler than buying physical property, but you still need to understand what types of properties the REIT owns: offices, shopping centers, apartments, hotels, and how it generates income. Passive income is where REITs really shine. By law, REITs must pay out at least 90% of their profits to investors. That means high dividends and consistent income, especially when properties are fully rented with long-term leases. Tax efficiency is great, particularly if you hold REITs in tax-advantaged accounts, like a stocks and shares ISA in the UK. Risk sits at a medium level. REITs are more diversified than owning a single property, but they're still affected by the real estate market. If properties sit empty or demand drops, dividends and share prices can fall. So how did mine do? 4 years later, my REIT investment is worth $98.59, a small loss of 1.41%. However, I earned $11.93 in dividends over that time. That puts me up $10.52 overall, or 10.52%. Not spectacular, but stable. Now, we move into the most controversial investment on this list: cryptocurrency. Crypto is digital money that isn't controlled by any government or bank. It runs on blockchain technology, which makes transactions secure and transparent. Bitcoin, in particular, has been the best performing asset of the last decade, but it's also incredibly volatile. The learning curve is moderate. You need to understand wallets, exchanges, and basic concepts like supply and demand. Bitcoin's limited supply is why it's often called digital gold. Passive income potential is moderate. Crypto doesn't pay dividends, but you can earn income through staking or yield farming. These methods come with higher risk, which is why I personally don't use them. Tax efficiency is poor. Crypto transactions are often taxable, even when swapping one coin for another. You also can't hold crypto in ISAs or Roth IRAs. Risk is very high. Prices can skyrocket or crash overnight, and scams are common. I stick to Bitcoin and Ethereum and store them securely. So what happened to my $100? I invested it into Bitcoin on Coinbase and left it alone. Today, that investment is worth $652.24, a 552.24% return. That's incredible, but not typical. Many cryptocurrencies fail completely. Crypto is high risk, high reward, and not for everyone. Gold is one of the oldest ways to store wealth. The learning curve is low. You can buy physical gold, like coins or bars, or invest through gold ETFs. I personally prefer coins and ETFs for simplicity. Passive income is zero. Gold doesn't generate cash flow. It simply preserves value. Tax efficiency is good, depending on how you invest. Some gold coins are tax-free in certain countries, and gold ETFs can be held in tax-advantaged accounts. Risk is medium. Gold is stable and performs well during inflation or economic uncertainty, but it doesn't grow as fast as stocks or crypto. My $100 investment is now worth $140.10, a 40.1% return. Solid and steady. Finally, index funds, my personal favorite. An index fund lets you own small pieces of hundreds of companies at once. Instead of betting on winners, you invest in the entire market. The learning curve is low. You don't need to analyze companies or time the market. You invest, hold, and let time do the work. Passive income is moderate thanks to dividends. Tax efficiency is excellent when held in ISAs or Roth IRAs. Risk is relatively low because of diversification. Historically, the S&P 500 returns around 8 to 10% per year over the long term. My $100 investment is now worth $179.57, a 79.57% return. Each investment has strengths and weaknesses. Some grow fast, some protect wealth, some generate income. The most important lesson is to start early. Even $100 can grow into something meaningful over time. Time is your biggest advantage. If you want to know the laziest way to make money online, check out the video on screen. But don't click just yet. Subscribe first if you want to grow your wealth. I'll see you there.